Hello, good afternoon, everybody. Hello, Steve and Scott, both saying hi here and hi back at you. This is Joe Lucey, and welcome to this week's Market Huddle. Special guest this week, we got Tony Shink. He's the head of the Institutional Relationships Department at Minneapolis Portfolio Management Group. Many of you are very familiar with MPMG. Many of our clients have used them and been very happy with the performance of them over the last, 12 months and over the last 3 to 5 years, or longer. So anyways, I wanted to bring Tony on. We've been doing this about once a quarter or so with Tony. I guess about 3 or 4 times last year we had you on, Tony. And it's a good, with the end of the year, getting into 2021, kind of take a few moments to kind of see where we've been more recently over the last 12 months, where we're at today, what are kind of top of mind with MPMG or Minneapolis Portfolio Management Group, what are they, what's on their radar, and then let's start to look at some projections for where we think things might be heading and what we should be doing with our portfolios. Keep in mind, whether you're an existing client of ours and already working with Minneapolis Portfolio Management Group, or maybe an existing client of ours but not working with MPMG, or maybe you're not a client and you would just have anything on your mind you'd like to discuss. At the end of today, we will, or at the end of the next 20 minutes or so, we will have an opportunity for everybody to schedule some time to visit with us. If you have any questions specific to Tony, we'll spend a little bit of time where we can do kind of a little Q&A, and if there's anything to follow up on, we'll make sure that we can address that as well for you. So with that said, without any further ado, welcome, Tony.
Well, thank you, Joe. Always an honor to be able to spend time with you and your clients and prospective clients. But first and foremost, we wish everybody a healthy and happy new year, especially after coming off such an abnormal experience that we have had over the last roughly 12 months. So I figured today I would start off just by kind of giving a quick overview of Minneapolis Portfolio Management Group for those that are not familiar with us, which is probably just a very few individuals. I'm hoping that's the case, so we can have that slide. There we go. Minneapolis Portfolio Management Group is an equity manager. We are trying to find great companies whose stock is inefficiently priced. And then we will hold on to them for quite some time, roughly 4 to 6 years, and then sell them off to the eager. A couple of the interesting things about Minneapolis Portfolio Management Group, or MPMG, is that it's a locally based Minnesota firm, and we've been around since 1995. All of the initial individuals who started this firm are still there actively running the portfolio and running the company. We oversee roughly $1 billion of assets for our clients, and it is fairly concentrated. In other words, we are just using our best ideas for our clients. And typically we hold these names for around 4 to 6 years. That gives our clients the opportunity for decent appreciation and long-term capital gains. Now, if you do have any other questions on our portfolio, we can always set up a call with ourselves, but more likely spend time with Joe and his team to learn more about MPMG and see if we would be a good fit for your overall investment strategy. But this is the reason why you came here, is to get an idea of what happened over the last year and what we expect going forward. Now, it was an extremely odd experience for most investors and just about anyone throughout the globe this year. We came off of the longest bull market in investing history. It crashed into a bear market in just under a month, somewhere between 20 and 30 days. The fastest deterioration of a bull market I've ever experienced. And what's very unique is the fact that this market that turned very cold very suddenly rebounded quickly. And within 5 months, we were back at all-time market highs after experiencing such a rapid decline in the stock markets. Now, if we go back to the beginning of January of 2020, we had just started to hear about the coronavirus. Nobody had any idea if this was going to turn into anything that was a real problem. And no one had any idea that this thing would turn into a pandemic. In fact, the first cases started just about 2 to 3 weeks within January. And as we started to learn more and more about COVID-19 or the coronavirus, the market had fallen about 3% by the end of January and started to pick up steam in February. And that's when more and more fear started to come into the markets. The idea that this virus would not be able to be contained, and that the World Health Organization, as well as other health organizations throughout the globe, were starting to get concerned. And we started to have a lot more uncertainty about what this actually means and if we will have a global pandemic on our hands, and how quickly we would be able to fight off this infection, or actually virus. And then by the end of March, we started to see businesses and schools start to close as the fear of a real pandemic started to increase. What was also interesting during this time period of market free fall is that oil started to drop quite a bit. And during this time, as everyone was afraid and there was fear going on about what this actually means, we at Minneapolis Portfolio Management Group started to take a look throughout these publicly traded companies to try to figure out, are there unique opportunities, iconic brands that will be able to sustain themselves through this environment and hopefully give our investors an opportunity to create wealth during this uncertainty. So we started to pick up businesses such as Starbucks, such as Disney, great iconic companies with tens of thousands of locations throughout the globe in the case of Starbucks. Disney with its ironclad vault of content, of great movies and theme parks. As we moved into the second quarter of this year, we were all quarantined. In fact, my children had social distanced me into my home office, and they only allowed me to come outside of my home office for curbside pickup of meals. They had had enough of that just after a few weeks of being home, because all of us started to get adjusted to this new environment. Oil actually went negative for the first time in history during the second quarter of this year because there was basically no demand. It was non-existent for both our automobiles as well as for manufacturing. We saw over 20 million people lose their jobs and look for compensation, looking for unemployment. We haven't seen this type of environment since the 1930s. And then, as soon as we started to hear about this during the throes of this market and the uncertainty of the pandemic, a company, Moderna, that many of us never heard of before April, started to say that they're seeing positive results in some of their experimental therapeutics that they were using, that they were getting an immune response. Markets started to percolate. Things started to look a little bit brighter, that there might be some opportunities out there, some shining lights of getting through this and the world reopening. And as that happened, just as we started to see lights turning on again, we had civil unrest here in our own state, George Floyd, all this civil unrest started to take place, as well as an uptick in the potential of trying to figure out who is going to be the next president of the United States of America during this civil unrest and this pandemic that was taking place. We had a wave of COVID infections. Things were still not looking up. However, gold was starting to move in a positive direction at over $1,800 now. So it was the first time in nearly a decade that we started to see gold at these levels. And then we started to hit third quarter. Technology stocks, work from home. We started to see more and more positiveness start to hit the markets. The dollar was dropping to its lowest levels, and yet silver had its best month in over 40 years during the third quarter. Even though we were starting to have a larger, more tense relationship with China, we continued to see technology, Microsoft, Facebook, Amazon, Tesla, Microsoft. There were 6 companies that actually accounted for nearly 80% of the market's performance for the first 3 quarters of the year. So during that time of performance for the market, even though we were doing okay, the S&P 500, if you minus those 6 companies that were driving it, you only had performance from the 494 other companies that account for about a positive 1.25% return for the market for the year. However, we started to see more and more things positively start to hit the markets. We started to see more and more numbers. We started to see more positive results coming from different vaccines. Things started to look better and better. And by the beginning of fourth quarter, starting in October, our markets continued to improve. We started to see more and more clarity take place, and we were hitting all-time highs by the end of December. So we were quite happy with what was taking place here. Now, really, what was driving this market rally? One of the things that we need to understand is that strong market performance is really a true testament to the resiliency of our country and the U.S. economy and corporate America. Like I was just saying, the uncertainty or the mistiness, we didn't have that much clarity with the election. We were seeing more and more clarity of how the U.S. election was going to take place, which gave us more confidence in what we can expect going forward. Stimulus. Global central banks were becoming more and more accommodative, trying to help and work through what we were experiencing with the coronavirus. Our Fed remains extremely ultra dovish, trying to throw everything it can towards coming up with a solution as we work ourselves through the coronavirus. Vaccines. We finally got emergency authorization from Pfizer, Moderna, companies that were hopefully global enough that were going to allow us to get inoculated throughout 2021. But most importantly, solid data, both from an economic, global standpoint, where we saw unemployment rates starting to fall, we saw labor participation rates starting to rise, and manufacturing as well as service indicators were pointing up. Then, as earnings started to come in for more and more businesses, we continued to see positive earning results from publicly traded companies. And we need to remember that the stock market is always a forward-looking indicator. And we believe that the market was telling us that better things are on the way. So as we looked at what was happening, less uncertainty and more clarity was taking place as we got farther and farther along our country. The election is a lot more clear of who is going to be running the United States as president for the next 4 years. Our Fed throwing the kitchen sink at the problem. Vaccines, getting emergency authorization to inoculate our country, and solid economic data and stronger earnings expectations in results from publicly traded companies. Now the question is, where do we go from here? People are really wondering, what do we see going forward? Do we have a crystal ball out there? And truly, the answer is no, we don't. I truly believe that only shamans and false prophets are going to try to tell you what's going to happen in the future. We don't know. We might have some ideas of what to expect, and we're very excited for what we see going forward with a lot of companies. And in fact, when you take a look at our portfolio, there is no way I would have expected us to be up over 18% for our portfolio for last year. However, that's what happened. We really worked at finding great companies, such as Starbucks and Disney, that's up over 80% since we purchased it back in March for our clients. Starbucks is nearly 70% up for our clients. We didn't know what was going to happen with the markets, but what we did understand is if we pay the right price for great companies and we're patient and we stay true to our convictions, and more times than not, this is going to reward ourselves, reward our investors. And most recently, as we start to look at the likelihood of our globe and our U.S. economy opening up, we're working to find great businesses that are going to participate in this reopening. Companies such as MSG or Madison Square Garden Entertainment. Here's a business that owns great premier locations. Madison Square Garden. They have businesses such as Radio City Music Hall in New York, Chicago Theater, and in Las Vegas, they're opening up a new venue called the Sphere later this spring, and they'll be opening up one in the near future in London as well. Simon Properties, a premier holder of malls and real estate throughout the globe. They are also buying the retailers that are using their stores as a unique way to increase their revenues as we start to see this globe opening up. Now, do we know what the earnings are going to be for the next year? We have no idea. Do we expect or hope for a good year? We do. We have no idea what that means from a return standpoint. But we believe that with finding great companies and staying true to our philosophy and our strategy, that over time we will be able to continue to provide decent returns for our clients and our investors. And since our inception, nearly 26 years ago, we have annualized a net return of about 11.7% per year for those 26 years, which is about 1.25% a year greater return than the S&P 500 during that same period of time. And with that, if there are any questions, I will open it up to that. Joe, do we have any questions?
I don't see any yet. Let's give everybody a few moments here. So I guess that my biggest questions that I get a lot right now here, Tony, is that, like you said, we really have no idea where things are going to be going. We use your firm and wealth accumulation, money managers, as a component of a comprehensive plan. But, most families are hiring us because of, number one, they want to make sure that they have their income in place. They want to have a plan for how to take their money back. They're looking to reduce taxes. And third, they'd like to increase their wealth, but not at the compromise of those first two areas. But with that said, I think a lot of families are somewhat surprised over the last, since November. There's discussions of another impeachment or something along those lines, or conspiracy type. There's been some discussions on whether or not there's going to be a smooth transition, but yet the investment markets seem to be continuing to go up. What is is there anything that's out there right now that you're kind of focusing on that's keeping you and the team up at night, that's managing the portfolio, or is it really just kind of making sure that the money that's exposed to your account should be money that isn't needed for 3 to 5 or 10 years, and it should be longer term money?
Great question, and an extremely difficult one to answer. Phil Grodnick, our senior most portfolio manager and the individual who came up with our strategy and philosophy, has said and continues to say the thing that keeps him up at night is not the problems of the day. He feels that the problems that are going on today, solutions will come about. We will get solutions to those problems and challenges that we are facing today. What keeps him up at night is the stuff that we don't see coming, because there's always a curveball someplace and we have no idea where that's coming from. And that's what's scary to him. Right now, with all of the news and media going on with the politics of the horrid pictures that we have seen at our country's capital, is not something we like to see. However, it seems that the market is taking a look and saying, this is bad. However, it's not going to be a midterm or a long-term problem for our country and our economy. When we look at politics, the two things that we're really focusing on more than anything else is how is a new government or the current government going to impact taxes, and how are they going to impact the openness or closeness for business. And based on those two policies really is what we're most concerned about when we're talking about politics. So right now, go ahead, Joe.
No, go ahead. You were wrapping up there, and I was going to come up with it. We've got a couple good questions that have come in here, Tony, so I was going to kind of transition to those, but I wanted you to finish your thought. Okay. So Steve and Jennifer both asked some questions, and I'll let you decide whether this is one or two questions, or now there's a third from Steve. But Steve had asked about what about Biden's promise to increase taxes? How do you think that's going to impact the portfolio? And then a follow-up question was really more about Medicare and health companies, and what if we go towards more of a public health option versus what we've been? And then Jennifer, which I think was really kind of associated with that first one, asked about the government debt and all the stimulus and things with the Fed. What do you anticipate? And I think that if I were to address it, I'd start talking about how interest rates may end up having to stay low for some periods of time. Any increase in interest is going to increase the amount of repayment on that debt. But outside of that, I think there's no question that we're going to start seeing taxes increase. So maybe it's really a question, Tony, about tax increases. How do you think that might impact the overall strategy or direction of the portfolio? And then are there any actions that Minneapolis Portfolio Management Group is taking around more of a government or a public health option, or changes around the Medicare system?
Well, first of all, with taxes, those ebb and flow throughout our country's history. And there is no question that we're going to see increased taxes in the near future. Now, personally, I think that with the coronavirus, we may have a point where we're not going to see taxes increase immediately until it shows that our economy is on stronger footing. So the coronavirus may help us temporarily with waiting to see any huge tax increases, or any tax increases for that matter. With our portfolio, taxes are going to increase the earnings of these companies. So one, that's what we look at, is how is this going to impact the bottom line of the companies that we're investing in? And two, because we're a value manager and historically hold companies or our investments for 4 to 6 years, we're really looking at making our money and being taxed on our wins, if you will, at long-term tax rates. And those historically have been significantly lower than short-term. And we don't see much of a change in the near future of that happening. So we are continuing to focus on any tax increases. How is that going to impact the earnings of these companies? And what are companies able to do to mute that impact? And two, I don't think there's going to be any change to this, which is looking for great companies whose stock is inefficiently priced. And we hold on to those for 4 to 6 years and get our clients into long-term capital gains rates. So I hope that answers the question on taxes. When you're taking a look at healthcare, right now, if you look at Medicaid and Medicare, our country is already around 40+% in some type of public health program. When our portfolio, we think companies like United Healthcare are actually going to benefit from having a more public type of an option available or increasing, because you're going to see more and more entrants into healthcare plans. And as that happens, we also think that United Healthcare is going to benefit from having more participants, as well as having more of their services being utilized throughout the country. So we are paying attention to that, of how this may impact our portfolio, impact other businesses and sectors within the market. Hopefully that answers the question, Joe.
Yeah, I think it does. I would add that, if you have money that's set aside in retirement accounts, IRAs, 401ks, 403bs, money that's never been taxed, I believe that the opportunity here to start to reposition those assets into something more tax advantaged, Roth IRAs, is going to start closing down. I agree with you. I think that it'd be unlikely that even though there was a promise of tax changes early in the administration, I think that may not come to fruition just with everything going on with the coronavirus and the economic slowdown. So I think that's a good point. But with that said, a lot of things that we preach, a lot of what we bring to the value for clients is not just about the wealth accumulation and using great partners like you, Tony, but also how do we start to reposition the taxes? I look at the taxes as worst case. We go back to where we were a few short years ago. And when I recall conversations I was having with clients just a few years ago, I was awfully excited about the opportunity of reducing taxes at those higher levels than they are today. So even with that said, I think it's likely, if we do see some tax changes, to go back to where we were prior to the tax changes that President Trump brought in, and probably doesn't put us much worse than where we were. But it's the we know that this opportunity, or we don't know, I believe that it's a very high likelihood that this opportunity to reduce taxes, take control of taxes, is closing down. And if you are in the golden decade, if you're near retirement or already retired, there is no better time than right now to really address these before we do see these tax changes. So that's my input. I kind of stepped all over you here, Tony. I apologize.
No, not at all. Our job, real quick, Joe, our job is to manage money for returns, for performance, not strictly taxes. That's where you come in to take a look at the full strategic plan.
Tony, are there any thoughts about maybe some positions that you have either lightened up on or even decided to move away from in the last quarter that would be worth discussing here?
We have started to lighten up on some businesses or some holdings. We have a heavy position in FedEx, which has done extremely well for clients over this time period, with the amount of ship to home that's been going on. Qualcomm, which has nearly tripled I think is up around 150% from when we bought it just about a year ago for our clients. We have started to trim those names really to manage that single stock risk, if you will, of holding those names. So we've brought those things back. I would not be surprised if we continue to see that happen throughout the year because we had such a solid year, which was extremely surprising for just about everyone.
Yeah. Well, unless we see any other further questions, I think we're right at about halfway down the hour, about half past. It's about 12:32 here Central Time on the 11th of January, and I have posted an opportunity, whether you're an existing client of ours, and then I see some names on here we haven't had in the office for a while. Would love to sit down. Let's start to look at some planning for 2021. We can do that virtually. We can do it face-to-face. We have really kind of figured out that Zoom and some of the social media or the streaming type platforms, even like we're doing this here today. So if you have questions, or if you would, if it's important to you to sit down for 2021, please don't hesitate to indicate with that offer I put out. There's an opportunity to get on the calendars. I've seen some names that I know have been in the office here once or twice over the last few years. If you're not a client of ours, don't hesitate to use that. We want to be a resource to everybody. So if you are not a client, or what you would consider to be a client of Secured Retirement, but would like to discuss or get a second opinion or what have you on your direction for 2021, feel free to mark that. I personally think that we're going to look back here at this last 12 months, including where we're at here today. And I think that when we look back in 3 or 4 years, we're going to be very pleased with the direction of where things are going. I think that right now is obviously a tough time with some of the slowdowns around the pandemic, and even some of the political challenges that are going on, and even some of the tax things. But I think that as we go forward, I think the United States is resilient, and I think we're going to do a great job. And I can't think of a better partner to be working with than Minneapolis Portfolio Management Group. You know, as Tony said earlier, they're a more concentrated portfolio. We believe in a concentrated portfolio approach because I think it's the only real way that you can expect to outperform market indices. You know, there's a lot of funds out there that are buying, well, not even 500 stocks. They may be buying 2,000 stocks, and then they're trying to compete with the S&P 500 as far as returns. It's very hard to do that. To outperform long term, we need to have a long-term horizon, and we need to make sure that we have a more concentrated portfolio, much like MPMG does for us with, what are you running, 25, 30 positions right now?
We're about 30, just over 30 names, and slowly getting that back to our sweet spot at just under 30 names. So
we think that that's the right approach for the wealth accumulation component of your retirement planning. So with that said, there should be a indicator there. Feel free to mark that, whether or not you're an existing client or maybe somebody has forwarded this on to you. You should be able to still use that link to schedule your visit with one of our team members here to discuss some things. If you have questions for Tony directly, please go through our office. We can schedule a conference call or what have you so that you can ask any of your individual or specific questions about the direction of their portfolio. But with that said, you know, I'm excited about 2021, and I think that going forward, 2021 is going to be a great year. I'm very optimistic about the direction of things from here. And we at Secured Retirement want to make sure that 2021 is the best year possible for you. I know, Tony, you share that. You'd like to make sure that everybody has a good new year. And again, we're here as needed, so don't hesitate to reach out to us. With that said, Tony, I'm going to thank you real quick, and then we'll go ahead and drop off the call here for today.
Well, great. Thank you for the opportunity, and hope everyone has a healthy and safe 2021.
Have a great rest of your week, everybody. Have a good day. Bye-bye.